9-month FY25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. K. Natarajan, Managing Director of Galaxy Surfactants Limited. Thank you, and over to you, sir.
Thank you, and a very good morning, ladies and gentlemen. It gives me immense pleasure to welcome you all to our Q3 and YTD December FY 2025 conference call. At the outset, this has been a relatively weak quarter. But despite the weakness, we are clear there are several one-offs that caused this. I will now be taking you through the factors that adversely impacted this quarter. Most of these factors are short-term by nature and structurally, let me assure you, we do not see any change in our growth trajectory. Let me start with the demand side. India makes up for 40% of our business. Weaker than expected festive season, the excess channel inventory, lower than projected government spending which spurs the rural economy, and unusually weak urban spending adversely impacted our volumes, registering low single-digit decline for this quarter. And this also was exacerbated by the fact that it started deteriorating from close to middle of November, beginning of November. While this is not encouraging, a lot of these cyclical blips as against any structural risk. Various measures such as reduction in grammage, slower scale-up of new launches, and slower than projected growth of the beauty and personal care segments also contributed towards this decline. While we see this continuing for one more quarter, we are clear that from Q1 25-26 onwards, things should start picking up as both rural and urban spending will drive the mass and prestige segment for the performance of actors. Improvement in systemic liquidity combined with the tax incentives provided by the government in the recent budget to incentivize consumption has laid the foundation for it. We have also seen lower funding for various D2C brands has contributed towards a broader slowdown of the Indian beauty and personal care market. Ahmed, while continues to remain flat, the Q improvement in volumes combined with the easing of supply chain-led volatility are major positives going into FY 25-26. Macro stability along with stability in demand will ensure more launches and better pickup going ahead. The rest of the world has been the highlight for this year, while pickup in premium specialty still continues to be below our expectations. We strongly believe the platform has been laid for a strong recovery for our premium specialties. While for this quarter we registered a 9% volume growth, the YTD volume growth stands at 20% driven by the prestige specialties. On the supply side, while easing freight costs, availability of containers and port congestion overall contributed towards reduced supply side volatility, the 40% rise in fatty alcohol prices during the quarter impacted sentiment and demand pickup adversely. From our experience, we can say that such phenomena does happen once in 2 to 3 years, given the inherent volatility in the palm and coconut oil value chain. The adverse impact on demand is usually felt for 2 quarters before the normalcy in price returns. We believe that this time too it shouldn't be no different. Apart from the one-offs, I will now say the groundwork that has been done by us to ensure the growth momentum sustains going ahead. While cyclical slowdowns and sudden rise in feedstock prices are part of the game and not in our control, enhancing our customer as well as product basket to ensure consistency in growth and profitability are some of the controllables that are well within our hands. Our new product, Galaxy Dama Green, has been getting very good response across developed markets. We strongly believe this will be a game changer as far as shower oils end-use segment is concerned, and these positive effects will be felt in the coming years. My surfactants as a category, though, did face headwinds due to the inflationary pressures in the developed markets and some reformulations. Traction and acceptance are now making a strong comeback. Given the range we possess, we are leaving no stone unturned to ensure faster approvals, enhanced presence across multiple applications and customers. Preservation remains a key focus area for us. Our upcoming launches in the field of sustainable and non-toxic preservation will lay the foundation for our next leg of growth in this category. To conclude, rough weather has always been part of sailing. While no one can ever predict the roughness, sailing despite these challenges continues to be our key imperative. The same is the story in Galaxy. While cyclical slowdown has been part of business, the extent always remains difficult to predict. Having said that, at Galaxy, we have always focused on the controllables so as to ensure when the weather turns, we are ready to sail ahead. We remain confident of our growth, and despite the challenges seen in this quarter, I assure you the structural story remains intact. Thank you, ladies and gentlemen, and over now for the Q&A session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to please use handsets while asking a question. Ladies and gentlemen, we will now wait for a moment while the question queue assembles. The first question is from the line of Aditya Khetan from Smith's Institutional Equities. Please go ahead.
Yeah, thank you, sir, for the opportunity. Sir, my first question is, sir, can you share the volume growth for 9 months? I believe, sir, you have mentioned that it is single digit, but
yeah, it is about
into the mid single digit or low single digit?
It's 4%.
4%. Okay.
Yes.
Okay. And sir, you have talked about the new product, so Galaxy Derma Green. Sir, can you share some data like what is the market size of this product, and is it more of a specialty product? And comparing with our current basket, so are the margins premium in this product, or is it more or less in line with other products?
So this is a premium product because this goes into shower oils, which is a big product that consumers use in the developed markets of the US and the Europe. So this is a green oil-soluble shower oil ingredient, so which ensures that this will deliver significantly superior performance of moisturization with ingredients that are green. So this obviously will be a high margin product, and we are building up a very good pipeline because because this was launched in the in cosmetics exhibition in April 2024, and since then we have been having a very good response from our customers, and a very healthy pipeline is being built. Many of the customers are sampling it, and they are making a formulation and testing it. Some of them are also doing consumer testing. So we see, based on these early signals, that this has the potential to become significantly big product in our portfolio.
Okay. Okay. Sir, onto the margin side, so that is clearly visible, so because of the higher raw material prices, we are witnessing some pressure on EBITDA spreads per kilo. So as you have mentioned in your last quarter, you were confident that second half would be better as compared to first half on spread side and all, but it seems like the number is coming onto the lower side, and next quarter also, so the commentary is not that good. Any ideas, sir, how things will shape up on EBITDA, like guidance what you have given of 20.5 to 21.5? Is there a downward revision, and what is the outlook on the L'Oréal icon pricing?
See, one thing the thing that really caught us off guard was the volumes started to get significantly lower, say from beginning of November, because I think many customers were looking at the Diwali season giving them a good demand comeback. But I think when that didn't happen, they took actions in terms of reducing the pipeline inventory pretty swiftly. Because with the increasing feedstock prices, they also didn't want to have more stock in the pipeline, because everyone has started increasing prices of the end products because they are no longer able to absorb it. They wanted to do grammage reduction. Okay, they wanted to reduce the schemes that are already introduced to incentivize consumption. So that was something that caught us off guard. The reason why, and obviously that also led to lower operating leverage, okay, impacting, because India is a significant market, and that really hits your bottom line. The other thing that led to that was the slower than expected conversion with some of our customers in the specialty ingredient segment. Although they're progressing well, we had expected certain conversions to happen faster, but they didn't happen because I think there were a lot of some of the customers do talk of some sort of uncertainties given the current tariff wars and the geopolitical situation. Some of them said they want to wait and watch. So there were some mixed signals, but the good thing is the work in terms of those projects in pipeline, they're getting it ready to launch and all that is pretty good. But I think there's been some hesitation in terms of going into the next phase of using and launching it. So that's where we are today.
Okay. Sir, is this slow uptick also because of the higher prices or because of the higher inflationary environment? Higher RM also is leading to the higher prices per kilo of the finished products. Is that also impacting the overall volumes, or is it only related to, you can say, what you are mentioning that from the customer side because of the lower grammage? So that is the only reason.
No, so one of the things is that the demand environment, if you see even the commentary from all our customers, they have been finding that the urban consumption has been impacted, rural also has not kept pace, and obviously the high inflation of feedstocks, makes all our customers not to take too much amount of positions in terms of maintaining very high inventory. Because when the demand is really not being robust, they don't want to build the inventory with a high-priced feedstock. Because they want to ensure that in the event that the price corrects, they don't want to be saddled with high-priced inventory with that. So they've been cautious. So if you look at it, this has been more with our Tier 2 and Tier 3 customers because their ability to have any hit based on certain feedstock inventory corrections is just pretty low. So that did impact the demand sentiment from our customers as well, which we have seen. And the oil alcohol prices have been continuously raising. In fact, November, December, it has gone up like we talked about 40% compared to last quarter. And most of it has happened in November and December.
Got it. Sir, so the rise in raw material prices, complete pain has been taken in our numbers, or there will be spillover in the next quarter also?
See, the only thing is this: when the price increase has to be done, they are done with a lag. So this is a typical thing. So we manage the risk pretty well, but then you're not able to pass on the price increases immediately because your prices run for a quarter, your prices run for a month. So whenever the next cycle comes in, you end up taking the new price and getting. But as you're doing it, you have one more increase coming in. So we are ensuring that we're managing it judiciously. So we don't see a challenge in terms of prices being passed on. But the collateral issue based on that is that the demand scenario gets more problematic because customers also increasing prices of their formulations in the market. So that is the issue that we need to be really concerned about. Our ability to pass on prices obviously is pretty much there, but it happens with a lag, which always is the case. Nothing new now.
Got it. So one last question onto the guidance on EBITDA, if you can just possibly share. And what is the volume guidance? Are we maintaining 6 to 8% band for the next 2 years, or there is a downward revision there? And what will be the outlook for the exports market? That would be my last question.
This thing is we are seeing this as a temporary issue. Structurally, everything is in place, so I have no reason to change anything with regard to my volume guidance of 6 to 8% for the next 2 years or the EBITDA guidance. We don't see that this is something, the structure that has changed, so it doesn't warrant any change in the guidance. Okay, for the next 2 years. Although for this year, full year, we'll probably end at 4% volume growth and EBITDA per metric ton in the region of between 19,500 to 20,000 per metric ton. Okay. But in the event that we do see there are some reasons for us to revise, we'll do at the appropriate time. But as of now, I see no reason as to why the guidance needs to be changed.
Okay. Thank you, sir.
Yeah.
Thank you. The next question is from the line of Rohit Nagraj from B&K Securities. Please go ahead.
Thanks for the opportunity. So you have mentioned about the 9-month volume growth. Can you let us know about the third quarter volume growth on a YOY basis for all the 3 regions?
That's a third. So like it was third quarter, I think we were about -7% in India. We were about -1.5% in AMET. Rest of the world was about 9.5%.
Yeah. And overall volumes were about a percentage lower?
Yes, -1%, correct, in the quarter 3.
So second question is in terms of the ex-India market. What are the levers in terms of incremental growth? So any which is ROW, I think since last January we've been seeing there has been a continuous growth. AMET, it grew earlier, then it had its own set of challenges, and now again it is back on track. So what would be the stable levers for individual geographies from growth perspective? And probably if you can also elaborate on the two segments that we are catering to, performance surfactants and specialty care across these two geographies. Thank you.
Yeah, so the levers, if you look at India essentially the government also seized off the issue, and that's how they have realized that the consumption needs to be now incentivized, and that's why the budget focused on that. And this is something that will be very critical because this now has to start reflecting in the consumers loosening their purse strings. And the government also is doing things that will certainly make this possible. So that is one thing. Otherwise, India has been growing pretty well for us. This probably is the first financial year where we have seen it after probably growing pretty well for almost close to last 4 years. So this we see that this consumption story has to kick in again, and things will come back. So that is the key stuff. With regard to all the other levers on our customer intimacy, on our capacity, everything is well on track. With regard to the other geographies like rest of the world, the levers are essentially to ensure that we hold on to all the new customer developments that we have done and the new business that we have created, and that we are very much in control of. With AMET, the entire thing was supply-led, things have improved. We do not see any headwinds on demand side, and we would expect this momentum to continue. The only thing, we should not have the geopolitical situation getting worse, and this is more from Africa, Middle East, Turkey perspective. As of now, we don't see any indications of that. We only see things getting better based on what we read in the media. And yeah, we would like the steady state as it is now to continue in India, the consumption to get back to its original robust state.
Right. Thank you. Just one last question on the US. So the recent tariffs that have been imposed, any positives or negatives for us as far as US geography is concerned or any other geographies are concerned? Thank you.
So the tariffs in US as of now, see what has been imposed on China, because the only thing that is effective is the additional 10% that has been imposed on all imports from China. So that is something we don't see anything significant in terms of uptick. We may see some customers looking at for some products they're sourcing, whether it's too critical for them that they can absorb this 10%, they may look at some sourcing from us, which our US team is working with the customers. But as of now, it's too early to comment. The duties on China, on Mexico and Canada has been kept on hold now for at least a month. If there is going to be duty that will come in, we'll have to see whether there can be some customers in Canada and Mexico who can start looking at getting it from Egypt or India, which we will see. I think, but as of now, we need to wait and watch. So that's why. But yeah, if you, our Prime Minister is there now, and then the whole thing is to ensure that for imports from India into US, the duties are not introduced. So let's wait for that meeting also to happen. That's, I think, probably tomorrow and day after, I guess.
So, thanks a lot. All the best. I'll come back in the queue.
Thank you.
Thank you. The next question is from the line of Sanjesh Jain from ICICI Securities. Please go ahead.
Yeah, good afternoon, Natarajan. Thank you. Couple of questions. First, from the profit perspective, if I look at last 5 years, we have been hovering around 300 crores of PAT. How should we see this growth? Because the 5 year haven't been that great from the growth perspective, from the profitability. And again, adjacent to it is that if I look at the return ratios, which used to be around 18 to 20%, now has dropped to almost 14.5% on an ROC basis and 13% on ROE basis. A significant deterioration. This also has to do with the profit hasn't been growing overall. How should we see this business shaping up? Because last 5 years is something which isn't the trend what we have seen earlier for the company.
Yeah, Sanjesh, you're right. So this is something that we, as I said, are seeing that has happened in the last about, more so in the last about 18 months. And we can give a lot of reasons which we have been giving every quarter. But one thing that I can assure is in terms of the actions that they are putting in place is going to start yielding results. Okay, we only want the external environment to be conducive, but as a group we are fully prepared and we have clear actions in pipeline to ensure that we come back to the growth trajectory that we are known for.
No, but return ratios, are they structurally down for us, or how should we look at the return ratios for the company?
Return ratios, because there are some investments that we did over the last 2 years, which obviously need to start picking up in terms of capacity utilization, which will happen. So this is more to do with in terms of timing of this investment. So that we don't see as a concern. It's temporary.
It's temporary. And from the capital allocation perspective, now that we are sitting on a lot of capacity, that's what the ROC numbers at least tell. How should we see capex from here on? That should materially reduce now that we are sitting on a lot of empty capacities?
No, we are at 70% capacity utilization. So it is not that. There will be certain products in which we may have to do capacity additions or debottleneck, which we will do. But then we only do when we reach about 80% capacity utilization in any product. So which will continue to happen. But will be, as is the case, we'll always be frugal. We'll only go for debottlenecking. If not, we will go for a brownfield. That's where we are. With regard to the capexes, will be more in terms of what we'll be doing in terms of getting ourselves equipped for the future in terms of our IoT 4 initiatives to make ourselves more capable, efficient. How we're going to be looking at digitalization in a way that can prepare us to handle the business of the future. So those will be something that will come in, which we will do because they'll have their own returns in terms of making us operationally much better and giving us better ability to be access newer revenue streams.
We used to run probably at largely 70-75% utilization if I look at so many years.
Right.
Then the capex is not underutilized that sense because then ROC is fairly reflective. Then what will drive the ROC improvement?
The ROC improvement will be driven. One is obvious. Second is in terms of how our specialty ingredients business picks up, and that has been something that has been lagging. And as I said, we expected things to get better from H2, which I've been saying on the phenol specialties. We do see a lot of production pipeline getting built, but they need to start converting. And team is aggressively working to ensure we convert it. Once that happens, things then start falling in place.
No, I thought we were at 17-18 with the mix when we started. And then we were thinking of return ratios going better from there with the mix improvement, right? We are now struggling even to reach the past level with all the mix probably not very different from the historical trend. So what are we missing in this reconciliation?
No, essentially, see, when it was, we also had certain, like in those years when we also had certain one-offs in terms of better realizations even on performance products given the ability to get in the, like you talked about the COVID years. So there were certain one-offs at that time also. So if you adjust for all that, we are still getting better in terms of the way that we are delivering on the weighted average, on the EBITDA per metric ton. The only issue is our specialty volumes need to pick up significantly. So we come back there. So that's what we are saying.
And one last question on this topic. How do we look at capital allocation from here? We have negligible debt on the balance sheet. How should we look at capital allocation between the capex, dividend payout?
Yeah, so we will follow the current dividend policy. We have certain business agendas and business initiatives for which will require some cash. We will be clearer as we move forward. But yes, our objective is to ensure that how do we use the cash judiciously and ensure that we return back to the shareholders at their appropriate time, which we'll work on.
Got it. Couple of questions for this quarter financial. It appears there is a stark difference between the performance of the parent entity and the subsidiary entity, that is consol minus standalone.
Correct.
Consol minus standalone has been pretty much stable, right? In fact, EBITDA margin have only gone up. What has changed in the parent entity business? What such a stark difference between the performance of two entities?
Yeah, that's because one is the parent entity has been where the major volume issue has happened in the India business. That is one. Second is that some of the specialty ingredients where the pipeline was being worked out, that hasn't flowered the way it needs to flower. So these are the two things. So major impact has been on the India degrowth of 7% that has impacted the India business.
But we have offset that through a much better growth in the ROW, right? And ROW generally is a better.
My specialty volumes have also degrown in the last quarter by 5%. Okay, so ROW also, the growth has been majorly driven by performance surfactants. And that is majorly, some of it has happened from our Egypt subsidiary.
Got it. And when should we see all this fructifying? Will FY26 be a year where we will go back to that 21 rupees kind of a EBITDA per kg and a 8-9% kind of a volume growth? Are you confident about that?
Yes, Sanjesh, pretty confident.
Got it. And then one last question on the cost. Though volume growth is not there, but if I look at our overall cost, particularly other expenses, that's been quite sharp for last 2 quarters. Even the freight costs have settled down. What is driving a 21-22% of the other expenses increase while volume has declined 1%?
So there have been some of the one-off situations that we have had, like a good amount of detention damages that happened in, say, our Egypt facilities because of all the issues on the supply chain getting impacted. Even in India we had, because the incoming supply chain, it started getting better, but you had shipments coming all at the same time. So that's been thing that has actually gone up. Otherwise, there's been nothing else to explain that increase. It's been those one-off in terms of those detention damage going up significantly.
So this 150 crore run rate, we should again go back to that 120 crore run rate, say, next quarter, right?
Which one?
The other expenses.
Yes, we should look at that. Okay, but then there will be certain one-offs are continuing in terms of some, I think, in Egypt, but then it will be much lower than what it was in this quarter. Correct.
Got it. Yeah. Thanks, Natarajan sir, for patiently answering all the questions.
Yeah.
Best of luck for the coming quarters.
Yeah, thank you.
Thank you. The next question is from the line of Arun Prasad from Avendus Spark. Please go ahead.
Good afternoon. Thanks for the opportunity. Sir, just you said again little bit coming back to the volume growth. So minus 1% YOY for the quarter. Is this a similar for performance and specialty, or there is a difference in the performance between these two categories?
So actually, specialty degrew by about 4.5%. Performance grew by about 0.5%.
Okay.
Yeah.
So this, but rest of the world did very well, but despite that specialty degrew.
It was majorly supported by certain performance surfactants that was the business that we did from our Egypt facilities.
Okay. So which means that on a sequential basis, we are roughly around 7 to 8% is a decline in the volumes.
Yes, correct.
Okay. And how much of this 7-8% decline is you will attribute to the seasonal from when you move from September to December quarter, and how much is because customers are rationalizing? Can you give a broad indication?
So there is actually no seasonality. Actually, October, November, December is a good quarter typically if you look at it. The whole thing has been in terms of in India, where all the customers have started pulling back in terms of reducing their inventory in the pipeline. That is what has led to this steep dip in this quarter and in India also.
Okay.
Yeah.
Sir, just if I look at it in another way, our volumes have declined by around 8% sequentially, and our absolute gross margin has also kind of declined by around 7-8%. So, is it right to understand that gross margin per kg should be more or less stable in this last 2-3 quarters?
Yeah, correct.
Okay. So large difference in the EBITDA per kg is because of the other expenses, and which you are saying if the one-off is not exactly kind of one-off, it will recover, it will keep recurring in the next 2-3 quarters also.
Yeah. So one is where the gross margins also need to start improving with the mix improving. That's what I said when I answered certain earlier questions. Okay. And in terms of cost, how do we ensure that we are able to keep the one-offs as real one-offs, and then incremental something happens, we need to manage, because there's more to the external scenario that we're talking about.
Okay. So this second is on the fatty alcohol prices. You said you have mentioned in the presentation that it's around $2.5 per kg. I see that it's still, even in Jan and Feb, it's hovering around $2.3, $2.4 per kg. So unless and until we pass some of these prices, fair to assume that this kind of margins will continue to reflect in our numbers?
So we are passing on, actually, albeit with a lag, because if you see the prices have been going up month on month, it has stabilized, say, probably for the last 2 months. Okay, and the problem is not passing on the increases. The problem is in terms of the impact is having on reviving the demand, which is already pretty low, at least as far as India is concerned. So that is the biggest challenge. The expectation is, and our customers are extremely averse to building their pipeline with these high stocks, because they are also passing on the price increases. Now, what will be the implication of this price increase on the demand side? We'll have to wait and watch, because that is another thing that the market is grappling with. So the best that can happen is where the prices start correcting, which we expect should happen. If that happens, then it's going to be good in terms of giving a good impetus to the volume growth in India.
Okay, sir, I'll put it in another way. At what point of time you will say, okay, forget about the demand, we need to protect our margins, and I will pass on? Is there some kind of a framework for this?
No, even otherwise we ensure that we pass on. It's not that we do not pass on. It's only with a lag. So all increases are passed on. It's not that we decide to keep volume by not passing on the increase. That we never do.
Okay.
It's only the timing difference, that's all. But then if this situation will not happen if it increases and stabilizes. But if it keeps increasing every month, then you may have some impact because it goes to the lag. That's all.
What is the average lag period, sir? Are we following M-1 pricing or Q-1 pricing?
So there are some contracts that Q-1, there are some contracts that are N-1. Okay, so it depends on what the contextual agreement. There are some customers who buy monthly, some customers who buy quarterly. Okay, so we ensure that we are able to have those things covered, but there will still be inventory that will be able to support that, even if there's a lag.
Okay, understood. Sir, just to answer the previous participant's question, you said you are working on certain actions to improve structural profitability of the business. Can you give us what is the kind of actions that you are taking, and which of those actions will give yield in a near term, and which will take some time to reflect in our numbers?
The two things: how do we build a strong revenue pipeline with regards to our specialty ingredients? That's something, a lot of actions have been taken, and we're building good amount of projects in pipeline, and that is something that's going to start yielding results as the quarters progress. That's very clear. The other thing is in terms of how do we prepare ourselves well in terms of the organization to be able to partake in the sort of external growth opportunities that we see as far as this market is concerned. So these are the two critical things. And then how do you start getting organized structure to keep it focused on all the critical initiatives, be it digitalization, be it the building our certain country-specific portfolios on specialty ingredients. So that will be the key initiatives that we will do. The other stuff that are pretty much more internal.
Right. All right, sir. Thank you very much for answering all the questions. All the best.
Thank you.
Thank you. We have the next question from the line of Archit Joshi from Nuvama Institutional Equities. Please go ahead.
Thank you, sir, for the opportunity. Just
Sorry to interrupt, Archit, but you are not clearly audible.
Yeah.
Is it better?
No, your voice is breaking.
Hello. Is this any better?
A little better, sir. Please go ahead.
Sir, my question was understand our India business a bit better. I was looking at the customer profiling that we continue to report in our investor presentation. The mix that we generally maintain, especially the MNC customers, largely 50-55%, and then there is regional and some other players that we continue to report. So that mix has largely been similar for the last few quarters, is what I was observing. And given the guidance of, kind of maintaining our volume growth to the extent of 6 to 8%, has there been any strategy to kind of, deviate or rather have a makeshift arrangement to kind of get into the smaller players? There are extensive amount of new brands that have come in the personal care category. So do we also have any propensity to shift that mix, or we believe that this 6 to 8% volume growth will be a function of the existing customer mix that we have?
No, see, if you look at it in India, when you look at the this thing, Tier 1, Tier 2, Tier 3 as we call it, there's no way that we can decide that I want to focus only on Tier 3 or Tier 2 even temporarily, because it's important that we focus on all the customers and their requirements in terms of serving their needs are very different. So example, we in India deal with all the D2C brands. But the issue that has been there is that most of them have been not able to scale up as they wanted to, given that there is a cost push, plus there is a demand cutback that has happened in the urban market. So all of them are talking about, many of them wanted to go from online to offline. They have held it back. They were waiting for probably the right time to be doing that. So we don't choose between the customer categories, because our objective is to ensure that we grow the business in the market, retaining our significant share, and we need to be engaged with all of them equally well. The need to be served is very different, which the team is aware of, and we serve them very differently. But we need to keep the focus on all of them. We can't decide to prioritize one over the other.
Sir, what I was trying to understand a bit better is, for example, this quarter you said that the festive demand was not as good as even the customers had anticipated. But since the Tier 2, Tier 3 and Tier 4, the products that are being introduced in the market, Hello? Yeah. So I was saying, the bottom of the tier, or maybe Tier 2, Tier 3 kind of customers who are also getting into the market, they have faced a similar phenomena, or is it that there are certain pockets where we can still have some room to gain more wallet share?
See, there we have seen, if you see, we have gained wallet share even when we lost volume in India, but with some customers, okay, because that's a continuing exercise. But that is not enough to mitigate the sort of degrowth you have from your large customers, no? It is not that you don't go. So individually, if you look at, when we review internally, there are customers, Tier 3, Tier 4 customers, we did grow our volumes with them. But those are on a small base, correct? And it can't offset the entire degrowth that happens from the Tier 1 customers, correct?
Correct.
Yeah.
Got it. Thanks for the clarification. Thanks and all the best.
Thank you. The next question is from the line of Shalini Gupta from East India Securities. Please go ahead.
Yeah, so I just wanted to check, what is your view on where do you think fatty alcohol prices will be in the next year and the next quarter?
Yeah, next quarter should be probably flattish at the current levels of 2,300, 2,400. I don't have a crystal ball in front of me, but my only wish is that it should settle down much lower, probably around $1,500, to ensure that your demand robustness gets back in with the customers, because that's important. Otherwise, the consumers end up paying there and they start taking their own actions in terms of reducing consumption, which is not good. So, but then I have no idea as to where to settle. But next quarter, I can, based on my understanding, it probably will be stable at these levels. But yes, it should come down for it to be beneficial for a growth momentum. It should come to $1,500 level.
Sir, what in your opinion led to this sudden price hike?
That was more driven by the prices going up for your palm oil and palm kernel oil. So if you see, the entire edible oil complex has gone up. Okay, and this essentially has moved up in sympathy with this majorly with regard to your palm oil going up. So if today your palm kernel oil from which fatty alcohol is made is about $1,700. FOB Indonesia, Malaysia. So that is what. And the same thing, the same time last year it was at around $900 to $950. So that explains.
So you're expecting palm oil prices to come down?
Yes, based on the high season months commencing. That's what I said.
Okay. And sir, my other thing was that earlier you were facing some supply side issue challenges. So have those eased now?
Yeah, they have eased. It can be better, but certainly it's not as acute as what it was in the first 2 quarters.
Okay. And sir, my last question, sir, you had said that you are expecting guidance at 20,000 per metric ton to 21,000 per metric ton. So that you're saying that for the next 2-3 years you maintain.
Yes, as of now, I don't see any reason to revise that guidance.
Okay, and sir, I just want to confirm EBITDA per kg in this quarter has been 15.7 rupees.
No, 17. It's been 16. Sorry, it's been 17,500.
17,500. Okay, sir. Thank you so much.
Thank you.
Thank you. The next question is from the line of Rohit Nagraj from B&K Securities. Please go ahead.
Yeah, thanks for the follow-up. A few clarifications and a couple of questions. One, in terms of fatty alcohol prices, so historically, whenever such a sharp surge has happened, you said it lasted for a couple of quarters, which in current parlance include 3Q and 4Q, and probably from 1Q onwards, the fatty alcohol prices should normalize. Is that the right assumption?
Yeah, see, because if you see the high season months in Malaysia, Indonesia for harvest of palm fruits and palm kernel is typically beginning of May. So that is what leads to that. So then that leads to inventory being higher, and then you have the palm and palm kernel oil prices coming down and reflecting in alcohol prices. So that's the expectation. And as of now, that's what the market expects, that things should start settling now, because everyone does say that it is currently positioned at a very high level, and it has reasons to sufficient indication it should come down, and we expect that the same lines.
Right. And our FY25 EBITDA per metric ton guidance of 20,500 rupees to 21,500 rupees is now postponed by 1 year to FY26. And thereafter, historically, we've been saying that it will be growing by about maybe 4-5% annually. Is that the right assumption to work with?
Yeah, so this year, I said I don't want to change the guidance because I see this as a short-term blip. So this year we will not be achieving that. It will probably be a 4% growth and close to around 19,000 tons of EBITDA per metric ton. But then we do see that we'll come back, to the guided range in the next year, as the quarters progress. But if there's anything that we see structurally different, we'll come back and say whether we need to revise. But we don't see any reason to do that as of now.
Sure. Now, my other question is on the CapEx front. So given that this year there has been muted volume growth and we probably have capacities to place the volumes even next year, would the CapEx guidance of, say, 150 plus minus crores be lower for next year or year after that, or will you stick to the same guidance?
No, I would want to be with this because there are some things that we're already planning, so we see no reason as to why we need to cut back on capex because we are always pretty deliberate and very frugal about both the timing of our capacity additions and also in terms of the cost at which we add the capacities. So whatever we see in terms of this required to keep us prepared to serve our customers, we will do that. So we'll be pretty deliberate about investing, but I don't see that we'll end up having significantly lower capexes next year. We don't see that.
Sure. And one last question. So we've been scouting for maybe any inorganic initiatives, given that there is a good amount of cash on the books. However, we have not been successful. So is the hindrance coming from any material technology pickup in our line of business, or there is any other factor that, traditionally, whatever surfactants we've been using, the same have been, modified to an extent and being used now. Only thing is that moving to some green chemistries, but there are no such players who are working on any better technologies or substantially better or other sustainable products, and that's why we are not able to get any leads. So just your thoughts on this.
No. So there are like we are engaging with customers and certain partners where we are able to get into some sort of a partnership to get that done. So many times you don't have to just make an investment. We will end up making investments or doing some your inorganic acquisitions only when we see that there's a need to do that to ensure that we are able to be secure. We are evaluating. We've been evaluating a lot of such options, but we don't find them in terms of the optimal situation which we would want to be going ahead. But this will be a good part of our strategy to grow forward because we have an aggressive growth agenda ahead of us. So we are constantly on lookout, but we will, just because we have cash, we're not going to get into any acquisition. That we are very clear. It has to be at the right value and for the right strategic purpose.
So, thank you and all the best.
Thank you. The next question is from the line of Aditya Khetan from Smith's Institutional Equities. Please go ahead.
Yeah, thank you, sir, for the follow-up. So my question was largely when we look at a span of 4 years, so last 4 years, so cumulatively around 700 crore has been invested in capital expenditure. Although on the EBITDA front, the number hasn't been that impressive because of higher other expenses, as you mentioned. But on gross side also, the conversion has been lower, despite your mix remaining the same between the performance and specialty. That has not been deteriorated. So what explains this thought?
No, see, the capacities that we set up have been for the premium specialties. So that is what we have been saying, where the sort of deceleration happened when you have in Europe and US, a lot of projects got held up or they were suspended because of the destocking and the inflation there. It started picking up in terms of the projects and pipeline getting built only in the last about 6 to 9 months. Okay, so the capacities we have set up are for premium specialties, so that needs to gain traction. And then that would set everything back in place. That's what I said even when I answered some question on similar lines previously.
Okay. And so the 700 crore which we have invested, any idea so wherein we have invested particularly into the specialty debottlenecking, and what was the amount if we can just...
That we don't share, but then I'll say that out of 700 crores, major was towards the specialty ingredients.
Okay. Yeah. So there the capacity has been expanded, you mean to say?
Yes, correct.
Okay. And so the further guidance onto the capex,
So we probably will stick to that same 150 crores that we do, but then we will see when is the guidance, but then we end up investing only when we see there's a real reason for us to be kicking it off. So that will continue.
Okay, got it. Thank you.
Thank you. We have no further questions, ladies and gentlemen. I would now like to hand the conference over to Mr. K. Natarajan for closing comments. Over to you, sir.
Thank you, ladies and gentlemen. Thank you for coming to this Q3 analyst call. And I look forward to talking to you, all of you again, and with a much better numbers. Thank you.
Thank you.
Thank you. On behalf of Galaxy Surfactants Limited, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.